Hello, everyone, and welcome back. My name is Greg Furman, and this is the Vantage Point AI Market Outlook for the week of December the 12th, 2022. Now, to get started this week, we'll begin where we always do with that very important US dollar index. Now, going into the final trading weeks of 2022, increased the height of volatility will be next week with the Bank of England, the ECB, and of course the much anticipated FOMC announcement. Now, again, the media spinning things out of control as to what the Fed is going to do or not going to do. I believe you're going to get a very aggressive Fed that is going to try and put the media back in their place here and get them to stop putting out disinformation, misinformation, which they've repeatedly done, despite the fact the Fed has been very clear as to what direction he's going in. So it will be a very, very interesting meeting. But I believe personally, in my respectful opinion only, that the Fed, meaning Powell specifically, will take a shot at the media here and say, okay, I didn't say this, I didn't say that, you said that. So again, you're going to see a lot of volatility leading up to and including this announcement. Now, when we look at the dollar, we can see that basically the last quasi bullish signal we've had on the dollar index was going all the way back into essentially the beginning of November. The dollar has been slowly falling down. We've had multiple retracements. Now, the dollar hasn't done well, but hasn't done horrible either. It's done fairly well against the Canadian dollar, against the Aussie dollar, but it's lost ground against the British pound, the Swiss franc. So a very mixed batch here. But I believe the Fed will set the course or the path of where he's going in 2023. But I also don't think he's going to say that there will be rate cuts or a pause anytime soon. So what we look for is, as long as we're holding below the T-cross long, 106.19 is our key level. Now, the indicators here are flashing a warning sign. Our neural index strength is turning back up. We've got a yellow on the neural index, which is basically a caution signal. We have an MA diff cross to the upside. All of this is warning of pending dollar strength, but it will be determined by what words that Jay Powell uses, which of course we have no control over. But again, if the dollar's been moving lower in the normal seasonal pattern, the dollar doesn't do well in the month of December. Now, the dollar is bucking that trend against some of the currencies, against some of the commodities, and of course the equity markets. So the main correlation that we would be watching next week is one up and one down. And when we look at this right now, this is a rare occasion where both the S&P 500 and the dollar index are both pointing down. But these are things we would expect in the month of December, particularly ahead of this Fed announcement that they're not willing to take dollar longs or shorts. They're not really willing to take a strong position in the equity markets either. But you can see we have the verified support zone, the low 39.18. Now, once again, be very cautious on this Monday's trading. It's going to be very, very choppy. This entire week will. But I believe that the bulk of the positions will be decided by this coming Friday. So right now, this is pointing lower in stocks. I think some clarification, because again, the media the other week suggesting that the S&P or the global stock markets are in a bull market is simply not factual and I don't even know what alternate reality they're living in. The yearly opening price on the equity markets on the S&P 500 is 47.78. We are still a solid 15, almost 20% down from that. We've been down 30% on the year. But when we look at the structure of the S&P 500 over the last year, it's actually quite ugly. And we look at the yearly opening price here. This is the first time in about 15, I would say about approximately 15 years, where the S&P 500 has not been above the yearly opening price, meaning it's been negative on the entire calendar year. So when they're calling for a bull market, I'm not sure where they're seeing that because again, we're still down close to 15% on the year. But if you look at the structure of this, people will attach wave theories to this. They'll use all kinds of wild and wacky indicators to try and analyze this. But the simple fact of it is we're making lower highs and lower lows. That is an indisputable fact. We have not been, if you bought the S&P 500 on January 1, 2022, you have consistently lost money this entire year. So yes, there is the possibility of the Santa Claus rally. If we get that, that will come courtesy of the Fed. I certainly have no control over what he's going to say, but I will say that my view is he is going to try and put the media in their place on Wednesday. That's what I think is going to happen here because, again, inflation has not come down anywhere near the amount that they're looking for on their target rate. So right now, keep a very, very close eye on these verified supports low. The 3,900 mark is a big level. The indicators here are pointing down. The predicted medium term and the predicted long term differences are both below the zero line and pointing lower. What that means is that there's a crossover has taken place. So if we click on F7 in our software, you can see that the blue line crossed the black line back here. So again, if we break down below this 3,900 mark and stay below 3,900, you're likely going to see a potential of a retest down at 37.44, potentially on a very hawkish Fed. We could even hit down into the 36 level. So again, expect a very volatile market. Now, when we talk about seasonalities, if we look at the people are assuming that oil will only go higher. The seasonal pattern, we've heard this from Kramer and some of these guys on CNBC. Vantage Point, to be clear on this, has forecasted oil going lower back here. We've had a retracement, but again, we have not had a trend reversal. Now, to make things worse, we're breaking down below the yearly opening price at 75.39. So the energy sector was very hot in 2022, but if you continue to hold these positions, you're now losing money. We've now turned negative on energy or at least on oil contracts on the year. So 75.39, the oil contracts have always, in my respectful opinion, been somewhat of a leading indicator for the dollar and for the S&P 500, and this favors the dollar over the S&P 500. So bringing in that intermarket correlation is very important. Now, what I've done before in the past, I've also brought in additional intermarket correlations to help confirm this. Now, you remember months ago where I had identified using the bull-bear gauge, using the intermarkets that drive other markets. Magna International stock, when it started to turn lower and it broke down below the Vantage Point T-cross long, this stock has 100% inversely correlated to the dollar index. This is the theory or the basis of intermarket technical analysis, that if Magna stock moves lower and it's 95% inversely correlated to the dollar index, then this too is warning of dollar strength. But again, it will be determined by the Fed. So for the savvy trader that can look at these things, keep an eye on this stock, because again, if the dollar does tank, then this stock will go. This will be a very good buying opportunity on this particular stock. But the indicators on Vantage Point right now, they are mixed, but they're warning us that this stock could be getting ready to reverse. So again, if this stock, Magna International, reverses above the key Vantage Point T-cross level of 59.50, then that will confirm to us the dollar is going to follow the seasonal pattern and it will move lower into the end of the year. But always remember, the main seasonal pattern with the dollar is that the dollar is very strong in mid-January to approximately mid-April. And that's something we definitely want to keep our eyes on. Now, when we look at, again, the Bitcoin continues to hold its ground, basically going flat. But just always remember, once again, the media spinning misinformation, disinformation about Bitcoin, making their comments, the reality, which they just don't seem to want to accept, or maybe they're trying to deter us. But Bitcoin's annualized returns 230 some odd percent for the last 10 years. This has been the number one investment. But Bitcoin is now classified as a commodity by the CFTC. Bitcoin has about a 98% positive correlation to the global stock market. So if the stock markets move higher, then Bitcoin will move higher. This puts the media, the disinformation and misinformation from the media at bay, because if we can identify these direct intermarket correlations, then we can disregard anything that the media is saying and say, okay, well, if stocks are the winner between this battle between the dollar and stocks, if stocks are the winner, excuse me, then Bitcoin will go higher. And it doesn't matter what the media is saying about this. So I would remain that the global stock markets will decide whether Bitcoin moves higher or lower going into the end of the year and next year. Once again, it's going to be tricky. The T cross long 17,069. One of the things I did see last week is Bitcoin moving higher. Even when the stock market was down, Bitcoin was going up. So and so is Ethereum. So keep an eye on the on this, because remember, Bitcoin's not just all about Bitcoin here, guys. It's about blockchain also, right? So and this has been the go-to for blockchain. So it'll be a very, very interesting year end. But again, watch your stock markets very, very closely. Now, as we look at our main currency pairs for this coming week, ultimately the Fed is going to decide the fate of the dollar, not me, certainly not me. So I'll be watching very closely. The euro basically not doing much of anything this past week. So what we want to do here is identify key support levels. 104.05, identifying the primary trend. The euro is still in a massive downtrend. The yearly opening price on the euro, 113.67. Very important to identify what the real trend is here, guys. Not what the media is saying, not what this indicator or that indicator. It's just if we bought the euro on January 1st, 2022, how did we do? Well, we did horrible, is how we did. The euro at one point well down below the 97 mark, so down some 15% or more on the calendar year. So again, we always want to make sure that we're identifying this. So our immediate verified resistance high, 105.95. Be careful on Mondays. Again, on Monday, you see this Monday, Tuesday reversal thing that's happening, that they fake you out, get you going in a certain direction on Monday, and then on Tuesday, they just pull the rug out from underneath you. Be very cautious. So any big move on the euro is likely to go the other way on Tuesday and Wednesday. But right now, we are above the Vantage Point T cross long, 104.05. But again, the euro US pair will have the most immediate effect by the Fed and the dollar index. If the dollar index goes up, the euro goes down. Period. Doesn't matter what the ECB does. If the dollar index goes down, then the euro moves up. That's the intermarket correlation here, guys. And then we just identify these key levels, 104.05. So the euro is not in an uptrend. It's in a corrective phase higher while we're above the Vantage Point T cross long, respecting the fact that primary trend is down. Okay. Now, when we look at US Swiss franc, once again, this will be decided by that dollar index. The Swiss franc usually is stronger in the month of December, the normal seasonality. But right now, as I've identified here, the seasonalities are not by a long shot, are they normal by any means. You've got oil prices down, equity prices down, and the dollar down. So this is not a normal December here, guys, like we've ever seen before. Not in the last 15, 20 years anyway, not that I've seen. So again, it's usually the dollar that's down in December, stocks are well up, oil's up. I don't disagree with those seasonalities, but they are not in play at this particular time. And it's largely because of the Fed. So what we'll do is we'll continue to monitor this, but the US Swiss franc, you can see that basically on November the 4th, when Vantage Point forecasted the dollar index was going lower, correcting lower, then the US Swiss franc followed. That is the trade. The indicators right now are still negative and still pointing towards further dollar weakness, but 91.01 is the yearly opening price. Be very cautious with shorts anywhere near that particular area, because again, the dollar real seasonal pattern in the dollar is that it's strong in January through April. So if it does move lower, that would actually be a buying opportunity. But what's also somewhat comical, and why using the yearly opening price is a powerful tool, is because what this also tells us is that from January 1, 2022, we're basically back to where we started. And that's why I've used that tool in my trading for all these many years. Now, the pound dollar, once again, the pound dollar, Bank of England this week, not a lot of buyers up here. Now, once again, you can see exactly when the pound started to move higher, when that dollar index on November the 4th, when Vantage Point forecasted the dollar index going lower, these other currencies immediately reacted to that. So the same thing is likely going to happen this coming week on Wednesday. The dollar is either going to continue to sell off into the end of the year, or it's going to reverse on a hawkish Fed. So we identify our key levels where our indicators right now are still bullish on the pound dollar. So the Bank of England could potentially help cable. There's no question about it. But that key level, 120.39, long while above that level, but we want to get down closer to this level. When we click on our F8 in our Vantage Point software, you can see this is our F8 is the long-term crossover without the black line, just the blue line by itself. And you can see the market every single day is in contact with this blue line. So we look for a breakdown of that line. That line is 121.90 and we've closed at 122.62. So another strategy that I've often implemented with the Vantage Point software is having my limit orders just below 121.90. So if we break down below that, that would tell me we're going to target lower to that, back down to that T-cross long. But for now, the indicators remain bullish. Our neural index strength, our neural index, and our predicted differences all showing some additional strength. Just be very cautious with Monday trading. Now, with the dollar yen starting to recover here, and rightfully so. Remember what this pair is. It is by definition the carry trade. So as long as even if the Fed stops hiking, guys, it's not going to matter. The Bank of Japan is negative rates. The U.S. is going to be 5%, probably minimum. So it doesn't bode well for shorts on this pair. Now, again, with that dollar index sinking, you can see that on the exact day the dollar Vantage Point forecasted the dollar index to go lower, dollar yen went lower. The intermarket correlation reigns supreme over anything. We just need a point in time as to when it's happening. So the breakdown below that T-cross long identifies this. So right now, again, another very effective strategy is to put a buy limit order just over the T-cross long. The T-cross long here coming in at 138.57. Now, if you want to stay with the trend here, with the current trend, not the primary trend, because the primary trend is still up. We're above the yearly opening price at 115.09, right? So the primary trend is up. You've got a carry trade. You've got a lot of strikes against the yen here, right? So one way we can do it is we can say, okay, when it's ready to resume its uptrend, we can be sitting there waiting for it because we know the exact level, 138.57. You put a buy limit order at, say, 139 or 138.70, 138.65. When it clears this predicted moving average, we're not chasing price here, guys. We're sitting here waiting for the market to come up and resume the primary trend, which either way we assume would be in the middle of January. So, but Christmas could come early, guys. It could be as early as Wednesday. So, or in the alternative, you can set up sell orders just below 138.57 and then have a stop reverse ready to go long at, again, around the 138.75, 138.80 area. That's a very viable strategy. The indicators here are warning the MA diff cross that we potentially are going higher, but the neural index strength and the neural index at the current time are not on board. When they get on board, then we should see the dollar yen move higher. Now, the U.S. Canadian pair, once again, a lot of strikes against the Bank of Canada did hike 50 basis points, but they're signaling an end is near. Now, the other problem for the Canadian dollar is the main correlation the Canadian has is oil and stocks. Both oil and both stocks are down. So the Vantage Point forecast of US Canada going higher, despite that known seasonality in equities and oil, that's not really happening, you can see that the Canadian dollar is being affected by that. So if the Canadian dollar is to advance higher, we need stocks and oil to continue to move lower. If we're looking at a potential recession, then there's at least a 60 to 70% probability that it's going to be difficult for the CAD to sell off here. We need stocks through the roof, and we need oil back up above its yearly opening price. Right now, the predicted differences are warning that it's losing momentum, but the verified resistance high that again I think I talked about in last week's weekly outlook is a little bit higher now at 137. The previous verified high, 136.45. So again, this is the level up here we want to keep an eye on. But even if it breaks higher, this 138.08, this is going to be very stiff resistance. I think shorts would be reasonable at that particular level, but that all depends on what we get from the Fed, because now the Canadian dollar doesn't have the advantage of the Bank of Canada continuing to hike when they're saying we're getting ready to slow this down, right? And I think the Bank of Canada has hiked way too much to begin with. Now, the same thing with the Aussie and the Kiwi, they're going to be dependent on what happens with the stock market. You can see that they have basically stalled. Right on this red line is the monthly opening price, the green line is the weekly opening price, and it just couldn't break through it. But we came down to the Vantage Point T-cross long at 66.88, and we bounced out of there, and we're trying to turn positive. So this is indirectly a positive for the S&P and the global stock markets if the Aussie can continue to advance. We see the exact same thing with the Kiwi, but the Kiwi is stronger, but also hitting into a newly formed verified resistance high at 64.42. So this level here, you can see we have a wall of resistance, including the yearly opening price at 68.32 on the Kiwi and 72.64 on the Aussie. So they're going, if we're talking about going into a recession here, that absolutely does not favor the Aussie or the Kiwi if they're going into a global recession, because stocks will fall and it will likely drag the Aussie, the Kiwi, and the Canadian dollar down with it. So with that said, this is the Vantage Point AI Market Outlook for the week of December the 12th, 2020.